Today, ladies and gentlemen, I've come to realize when building a stock portfolio, it is like building a team. And unfortunately, your quarterback is only as good as your defenseman, but too often we fixate on those star players. And I have gone through the largest reweighting in my stock portfolio than I have in the last few years to readjust my risk tolerance into what I believe are going to be volatile times. I've got my dividend yield up to the point now where I'm making over $800 a month, which is incredible passive income, over $9,000 annually. And though this might sound really dramatic, trust me, it's not. I've just in mild reweightings to adjust all of the percentages. So from the Canadian perspective, we are going to go through my TFSA, my RRSP, my managed account, along with my corporate investment account. Then finally, we're going to take a broader view perspective from the spreadsheet so you can see how all of these things intertwine and play on the team together. If this is something you appreciate, I feel like this is going to be very educational in the clarity of that transparency. Just do me a favor, hit that like button, folks, and let's get right into this with first and foremost my tax-free savings account. Today worth $169,000. What I went ahead and did in here is I pulled back one of my longest standing stocks I've ever held, which is Northland Power, this kind of globally diversified wind and solar company. I pulled it down by like 50% to re-add to Algonquin Power along with TELUS Communications. And TELUS just posted earnings. We are coming up in the Canadian earnings season. So we had Reweighting, TELUS, we're getting into the banks, the utilities, and I kind of want to ride through that because so far it's been very good. And I'm already up on the TELUS position, diversifying this tax-free savings account. Still really pleased with my banking positions. I don't feel like they're too big yet to have to ever scale them down. So that's where I'm kind of looking on the TFSA side for the Canadian portfolio. On the US side of this, I mean, it's been a complete insane volatile ride, especially with the Federal Reserve coming up in March, where interest rate hikes are likely to come. And in this inflationary market, there's still continued fears of how this is going to pan out. So I did scale Apple down, I scaled Microsoft down, and I repivoted those into VYM, which is a kind of diversified US, kind of like almost like an aristocrat ETF almost. Just really great dividend stocks that I love, foundational, offer further diversification. It is next to my Vanguard S&P 500 index, and I left some room with these companies because that's where for the time being I plan on reinvesting the dividends for further stability. So let's talk about the managed account, where I'm going to be doing a lot of shifting still because Ryokan just posted earnings. This is the largest position currently in my portfolio. It is largely overweighted, and don't get me wrong, I thought those earnings were great. They increased the dividend. There's no reason to sell it other than my risk tolerance. I do not want these positions making up such large scales because you just don't know what you don't know. And I was not expecting Facebook to slap me upside the head. So in this account, I actually already sold Facebook at a capital gain. I took all of that money and I deposited it in my RRSP because it defers. And basically, I don't have to pay any of the capital gains tax. And it also lowers my income tax for the year for my regular income. So with Ryokan, however, I'm going to scale this down by about 20%, maybe pull out 5,000 or 6,000. I'm going to get rid of Bank of Nova Scotia because I own a lot of that. And I'm looking to pivot it into Smart Centers or another high yielding REIT after we get through earnings, just so I know there's some reliability because I don't want to take on any more risk without me actually knowing when I'm buying these individual companies. But coming out of the managed account where everything in here is fully taxed, in the RRSP, guys, depositing that Facebook money, I ended up buying Pfizer and VYM. I was talking about Pfizer earlier this week. Their vaccines and drugs have now touched over the last year 1 in 6 people. That is a distribution and a logistics marvel in the healthcare sector. And I kind of put fair value on this company between $35 and $40. So I am leaving room to continue to cost average into it, as I still have about $5,000 worth of contribution room to this account. Now, what's beautiful about the RRSP as well is when you buy US dividend stocks, you actually waive the withholding tax. Because if you're in Canada and you're buying over the border companies in the US, you're going to get slapped with a 15% tax, which even though my TFSA is 100% tax free, I still pay the 15% over the border on my Apple and most of those US companies. So in here, I don't know how they get away with it, but there's zero tax on any of these dividends. And because I look at this kind of a long-term retirement account that I can draw off of if I so need to, I really want the stability of kind of these large cap consumer discretionary and healthcare companies with a mix of index funds. So we can see that I added VYM, already have VOO, and basically between VOO, VYM, and Pfizer, I'm going to continue to top those positions up with dividends and further contributions in the coming months. And that's kind of where that account particularly sits. And then finally, the corporate account. Now, this is an account where I can't really pull this money out without getting crazy taxes on it because it's already getting tax deductions and really good taxation because it's through a corporation where you only end up paying 13% income tax on the first $500,000. So I opened up a corporate investment account to continue to kind of make capital gains tax deferred, and then I can figure out how I can play with them a little bit later on. This account today is worth $75,000. It's important to iterate that my RRSP is at $55,000, and along with my regular brokerage accounts, it's around $44,000. But in this account, guys, I have done some more reweighting. I did ended up selling down Tesla in here because obviously, like, I was so convicted to Tesla. I still love it with a passion, but I can't be overweighting for my current risk in this environment. So I did scale it down, and using that capital, I topped up Facebook in this position to start repositioning it into the corporation, rather my regular brokerage accounts. And then on top of that, guys, I took a little bit of that money and I did add more to Royal Bank because, like I told you guys, I really like the banks here. Very excited for the earnings period to come up. So when I talk about reweighting, I mean, this sounded a lot more aggressive than it probably looks like it does now. And bringing this into a full view picture, taking a look at the portfolio where it sits today, guys, what this has done is it's balanced out my dividend income, and I also made sure that nothing really made up much more than 5% of the total portfolio, kind of following that Kevin O'Leary mindset that you shouldn't have any more of your net worth in one individual investment, because like I said, when things like Facebook drop, it hits pretty close to home here. So far, the largest position in the whole portfolio today is, of course, Ryokan, right next to VOO. But like I said, over the coming weeks, I look at planning obviously scaling Ryokan down. My growth weightings now in this portfolio, guys, let me refix that. I have these a little bit darted out, but the growth part of the portfolio consists right now of Bitcoin. What do we got? We got Bitcoin, Facebook, Apple, Microsoft, Google, and then of course Tesla here, guys. And basically that no longer makes up about 27% of the entire portfolio, and I kind of darted out all the companies that are paying dividends. So obviously Apple and Microsoft are the only percentage of growth paying dividends. About 20% still not really flushing any dividends. Actually, I think it's closer to 15 to 16%, which would be Bitcoin. Obviously, we got Facebook, Google, and Tesla. But again, guys, I'm still adding to these growth positions. Don't get me wrong. Like, I've been cost averaging into Bitcoin now for the last month and a half. I've added almost $300 as it's been trading down and doing these up and down swings, which, by the way, I keep reiterating this. Shakepay, guys, if you're Canadian, free Bitcoin every single day in this incredible promotion that if you come in through an affiliate link, shake your phone in the app every day, they exponentially give you more free Bitcoin. Plus, you deposit $100, you make 30, I make 30, a referral link below. But outside of that, looking at the cash position, this is where the next biggest changes come into play here, because I want an emergency fund. I'm kind of like a Dave Ramsey. I really believe in the philosophy of zero debt, no debt whatsoever. I mean, credit card, car debt, student loans, none of that. That all has to get wiped out first. I got none of that. And then what I want to do is build a 6 to 12 month emergency fund in case the car breaks down, in case there's housing repairs, in case I lose my job. Because you might recall in March of 2020, guys, I lost my career and my portfolio dropped 30%. I don't want to be in a position where I'm relying on my portfolio for an emergency fund, because you don't want to pull out long-term investments in periods where they're down and there's volatility in your life. So I've got about $15,000 in cash. I still haven't paid tax yet. I'm kind of finishing up taxes. I'm going to owe a lot, but I still have a lot of cash just sitting here, and I'm trying to get that up to about $20,000, and I'm putting it into a GIC account, because unfortunately the regular savings accounts only pay out about 0.05%. They're absolutely abysmal. And right now, GICs are paying at about 1%. So obviously I can make $100 to $200 on $15,000 to $20,000, and I can draw against it whenever I need it safely without being penalized. But unfortunately, interest rates are going to be going up this year. And the lady told me, because I'm like, well, what if interest goes up? I want a higher interest rate. And she said, well, we'll have to readjust, and you'll have to pivot some things around, because unfortunately these are like locked in rates, but it is what it is. So that's where I'm currently sitting with the cash. But bringing all of this together, the fact that I'm able to still cash flow Bitcoin, I'm able to cash flow my cash, bringing it all into view, I'm making over $9,700 as of this current moment. Once I adjust Ryokan, it'll probably be closer to about 9,800 is the goal. And then I'm primarily focused on only two things: reinvesting dividends into index funds, along with primarily just stacking cash, probably for the foreseeable next 3 to 6 months until I see how the quarters play out, because I don't trust Apple not offering guidance. I don't trust Google not offering guidance, especially considering the guidance we got out of Amazon and Facebook. You couple that with the fact that the Fed's going to be very on top of interest rates, not caring about the market as much as they do about kind of getting control of this environment. I would just be very cautious and careful about how you're driving your money into this market, but it depends on your perspective. I can't tell you what to do, because obviously if I had no money, I would be more inclined to keep buying, but because I want to protect the wealth I have and take opportunities of dips, It's currently what I'm doing, folks. So I pass the question off to you. I'd love to know what you think about all this in that comment section below, but stay cool, stay awesome. And as always, I look forward to catching you in the next one.